Lucent's channel stuffing, when Bell Labs' innovation met greed. In the hallowed halls of Bell Labs, where the transistor was invented and the future of telecommunications was born, a different kind of innovation was taking shape in the late 1990s. But this wasn't about breakthrough technology or revolutionary discoveries. This was about the age-old art of financial manipulation, dressed up in the Silicon Valley rhetoric of disruption and growth. Lucent Technologies, spun off from AT&T in 1996 as the crown jewel of American innovation, was about to become one of the most spectacular examples of how even the most prestigious companies can fall prey to the intoxicating allure of fraudulent accounting. Between 1998 and 2000, Lucent would artificially inflate its revenues by over $1.1 billion through a sophisticated scheme of channel stuffing and vendor financing that would ultimately destroy one of America's most respected technology companies. The story begins not in some fly-by-night startup, but in the offices of a company that employed 11 Nobel Prize winners and held over 30,000 patents. When greed infected the DNA of innovation itself, the results would prove catastrophic for employees, investors, and the very notion that blue-chip American companies could be trusted. When Lucent Technologies emerged from the breakup of AT&T in April 1996, it carried with it the weight of telecommunications history and the promise of an internet-connected future. The company was essentially the manufacturing and research arm of the old Ma Bell empire, inheriting the legendary Bell Labs along with massive manufacturing capabilities for telecommunications equipment. At the time of the spin-off, Lucent was valued at approximately $3 billion and employed over 130,000 people worldwide. The timing seemed perfect. The internet boom was just beginning. Telecom companies were expanding rapidly to meet growing demand for data services, and investors were hungry for technology stocks that offered both innovation and steady revenue growth. Lucent's customer base included virtually every major telephone company in America, plus rapidly growing international markets hungry for modern telecommunications infrastructure. The company's product portfolio ranged from basic telephone switches to cutting-edge fiber optic equipment, positioning it perfectly to capitalize on the digital revolution. Wall Street analysts were bullish, predicting steady growth as the world's appetite for bandwidth seemed insatiable. But beneath this rosy exterior, the pressure to meet quarterly earnings expectations would soon transform America's most innovative company into a house of cards built on fraudulent revenue recognition. The mastermind behind Lucent's financial engineering was not some rogue accountant working in isolation, but rather a systematic approach that started at the very top of the corporate hierarchy. Rich McGinn, who became CEO in 1997, was a charismatic leader who had spent his entire career at AT&T and its predecessors, rising through the ranks with a reputation for hitting aggressive targets. Under McGinn's leadership, Lucent adopted what they called an aggressive growth strategy, which translated into quarterly revenue targets that seemed to increase regardless of market conditions or realistic sales projections. The company's finance team, led by CFO Oren Schaffer, developed increasingly creative methods to ensure that reported revenues met or exceeded Wall Street expectations every single quarter. This wasn't accidental or the result of isolated decisions by individual employees. Internal documents would later reveal that senior management actively encouraged practices they knew were designed to inflate current period revenues at the expense of future quarters. The culture became one where making the numbers was paramount, and questioning the sustainability or legitimacy of revenue recognition practices was actively discouraged. By 1998, meeting quarterly targets had become so institutionalized that managers throughout the company understood that their careers depended not on building sustainable business or developing innovative products, but on finding ways to accelerate revenue recognition regardless of the underlying business reality. The technical mechanism behind Lucent's fraud was a practice known as channel stuffing. But the company's implementation of this technique was far more sophisticated than typical examples of this type of manipulation. In traditional channel stuffing, companies simply ship more products to distributors and retailers than the market demands, recognizing revenue immediately even though the products haven't actually been sold to end customers. Lucent's approach was far more complex and involved multiple layers of financial engineering that made detection extremely difficult. The company would offer distributors and customers increasingly generous financing terms, essentially lending them money to buy Lucent products that they didn't immediately need. These transactions were structured as legitimate sales, allowing Lucent to recognize revenue immediately, while the financing component was often disguised or buried in subsidiary arrangements. The company also engaged in extensive bill and hold transactions, where they would invoice customers for equipment that remained in Lucent warehouses, sometimes for months. Additionally, Lucent began shipping partially completed products or products that didn't meet customer specifications, recognizing revenue while knowing that the sales would likely be reversed in future periods. Perhaps most egregiously, the company began offering customers free products and services as incentives to purchase other equipment, but would then recognize revenue for the entire transaction value, including the supposedly free components. The vendor financing component of Lucent's scheme was particularly insidious because it created the appearance of a growing, healthy business while actually undermining the company's financial foundation. Through various subsidiary companies and off-balance sheet arrangements, Lucent essentially became a bank for its own customers, lending them hundreds of millions of dollars to purchase Lucent products. These loans were often made to startup companies or financially unstable customers who couldn't obtain traditional financing, meaning that Lucent was not only artificially inflating its sales, but also taking on enormous credit risks that weren't properly disclosed to investors. The company would recognize revenue immediately when these financed sales occurred, but the cash flow impact wouldn't be felt until much later, if at all. In many cases, customers who received vendor financing were unable to repay their loans, meaning that Lucent's reported profits were based on transactions that would never generate actual cash. Internal documents later revealed that by 1999, Lucent was providing financing for more than 25% of its total sales, a staggering percentage that was never clearly disclosed to investors or analysts. The company's credit department repeatedly raised concerns about the quality of these financed customers, but senior management consistently overruled these objections in favor of meeting quarterly revenue targets. This created a vicious cycle where each quarter required even more aggressive financing arrangements to maintain the illusion of growth, pushing the company deeper into unsustainable territory. The impact of these accounting manipulations on Lucent's reported financial performance was dramatic and, for a time, exactly what Wall Street wanted to see. Between 1998 and 2000, the company reported consistent revenue growth that seemed to validate investor enthusiasm for telecommunications infrastructure stocks. In fiscal year 1999, Lucent reported revenues of $38.3 billion, representing growth of over 20% from the previous year. The company's stock price soared from around $20 per share in early 1998 to over $80 per share in late 1999, making it one of the best-performing large-cap technology stocks during the height of the dot-com boom. Lucent's market capitalization briefly exceeded $250 billion, making it one of the most valuable companies in the world and validating McGinn's aggressive growth strategy in the eyes of investors and analysts. The company was regularly featured on the covers of business magazines as an example of how traditional industrial companies could successfully reinvent themselves for the internet age. Lucent's seemingly consistent ability to meet or exceed quarterly earnings expectations made it a favorite of institutional investors, and the company's stock became a core holding in many technology-focused mutual funds. But beneath these impressive headline numbers, the reality was far different. The company's actual cash flow from operations was significantly lower than reported earnings, and an increasing percentage of reported revenues came from transactions that would prove uncollectible or would be reversed in future periods. The unraveling of Lucent's financial house of cards began in late 1999 and accelerated rapidly through 2000 as the unsustainable nature of the company's revenue recognition practices became impossible to hide. The first major red flag came when several customers began returning equipment they had purchased under Lucent's aggressive financing programs, forcing the company to reverse previously recognized revenues. As the dot-com bubble began to deflate, Many of the startup companies that had been major Lucent customers simply went out of business, making it clear that the vendor financing arrangements would never be repaid. The company's own distributors began complaining that they were holding excessive inventory that they couldn't sell, undermining the fiction that the channel stuffing represented genuine market demand. Perhaps most damaging, several major telecommunications customers began publicly questioning Lucent's business practices, with some alleging that they had been pressured to accept equipment deliveries and financing arrangements that didn't make business sense. By the third quarter of 2000, Lucent was forced to announce that it would miss earnings expectations for the first time since the company's spin-off from AT&T. This announcement triggered a massive sell-off in the company's stock and prompted intensive scrutiny from analysts, investors, and eventually regulators. Internal investigations revealed the extent of the revenue manipulation, forcing the company to restate earnings for multiple previous quarters and acknowledge that over $1.1 billion in previously reported revenues had been improperly recognized. The human cost of Lucent's financial fraud extended far beyond the executives who orchestrated the scheme, devastating employees, investors, and entire communities that had depended on the company for economic stability. When the accounting irregularities became public in late 2000, Lucent's stock price collapsed from its peak of over $80 per share to less than $5 per share within 12 months, wiping out more than $200 billion in shareholder value. This wasn't just a loss for wealthy investors or institutional funds. Lucent's employee retirement plans were heavily invested in company stock, meaning that thousands of workers saw their life savings evaporate virtually overnight. The company was forced to implement massive layoffs, reducing its workforce from over 150,000 employees at its peak to fewer than 35,000 by 2003. Entire communities, particularly in New Jersey where Lucent had major operations, were devastated as the company closed facilities and eliminated thousands of high-paying manufacturing and engineering jobs. The Bell Labs research organization, which had been responsible for fundamental breakthroughs in technology for over 7 decades, was gutted as the company desperately tried to reduce costs and survive the aftermath of the accounting scandal. Many of the startup companies that had been customers in Lucent's vendor financing schemes also went bankrupt, unable to repay their loans and lacking the telecommunications equipment they needed to operate. The ripple effects extended throughout the telecommunications industry, as other equipment manufacturers came under scrutiny for similar practices, undermining confidence in the entire sector during a period when technological innovation was desperately needed. The legal and regulatory consequences of Lucent's channel stuffing scheme were swift and severe, though many observers argued that the punishments didn't match the scale of the fraud or adequately compensate victims. The Securities and Exchange Commission launched a comprehensive investigation into the company's accounting practices, ultimately filing charges against multiple Lucent executives for securities fraud, books and records violations, and making false statements to auditors. CEO Rich McGinn was forced to resign in October 2000, though he avoided criminal prosecution by cooperating with federal investigators and agreeing to pay substantial civil penalties. CFO Orrin Schaffer and several other senior finance executives were similarly forced out of the company and faced both civil and criminal charges for their roles in the scheme. The company itself was forced to pay over $25 million in fines and penalties to settle SEC charges, though this amount was dwarfed by the billions of dollars in shareholder losses caused by the fraud. Perhaps more significantly, Lucent was forced to implement extensive new internal controls and oversight procedures, essentially admitting that its previous financial reporting processes were fundamentally flawed. The company's external auditors, Arthur Andersen, also came under intense scrutiny for failing to detect the revenue manipulation despite conducting annual audits throughout the period when the fraud occurred. Multiple class action lawsuits were filed on behalf of shareholders who had purchased Lucent stock based on the inflated financial statements, ultimately resulting in settlements totaling hundreds of millions of dollars. The Lucent Technologies scandal stands as one of the most instructive examples of how channel stuffing and vendor financing can be used to create the illusion of corporate growth while actually destroying long-term value for all stakeholders. Unlike some corporate frauds that involve exotic financial instruments or complex derivatives, Lucent's scheme was built on relatively straightforward manipulation of revenue recognition timing, making it particularly relevant for understanding how even sophisticated investors and analysts can be deceived by determined management teams. The case also demonstrates how the pressure to meet quarterly earnings expectations can corrupt even the most prestigious and historically successful companies, turning innovation and engineering excellence into casualties of short-term financial manipulation. The aftermath of the Lucent scandal contributed to broader regulatory reforms, including enhanced scrutiny of revenue recognition practices and stricter requirements for companies that provide financing to their own customers. The destruction of Bell Labs as a world-leading research institution represents one of the most tragic consequences of the fraud, as the pursuit of quarterly profits ultimately undermined the long-term technological leadership that had made Lucent valuable in the first place. Today, the remnants of Lucent Technologies exist as part of Nokia, a shadow of the company that once employed Nobel Prize winners and drove fundamental advances in telecommunications technology. The lesson is clear. When innovation companies prioritize financial engineering over actual engineering, they risk not just their financial health, but their very reason for existence.